Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I'm back with more strategy on the market at large and how we can use closed-end funds to improve our investing. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. Honestly, hopefully not much because the cat's locked away. I'm not a financial advisor. I am a financial strategist, and I do not talk like a herd. Something I continue to say and will continue to say because honestly, I don't like their pretense. I don't like their condescending chatter. So I walk in limited company, and most times lately I walk alone. Um, so the Fed dropped rates, and the market is still up and down per se. It was not an instantaneous. They cut rates and everything took off in the sense of everything just jumped up to what it was before. But for the most part, the market's in a better uh, situation than it was a week prior to the Fed dropping rates. Um, of where we are exactly, and I'll share screen and you can look at the fear and greed index. We're in greed territory, and regardless of how the specifics of these individual graphs are calculated, we're in greed, or say we're at least in this upper edge of greed into extreme greed. And that makes me cautious. It also makes me cautious looking long term. So we knew the Fed would drop rates, and most everybody says they're behind the curve, which I would agree to that. We're back to quiet printing money to loudly printing money. And the Fed is still trying to influence the election. They plan further rate cuts, but it kind of, say, from my standpoint, it's almost like they're trying to hide the overall state of the economy. So they manipulate everything up until this point. They delay the rate cut until everybody can pay attention to it, and they're behind the curve in the sense that they waited too long. The economy itself is not in a great situation. Everything right now costs more than it ever has. If you've noticed your grocery bill, it's still going up. Oil is going down, which doesn't make any sense. OPEC decided to cut production and got the majority of their conglomerate on board with that. So if anything, oil ought to be going up, but actually the cost of gas is going down, which I think is a further attempt by the system at large to control the narrative of the election. Hey, look, the economy's not that bad. We're cutting rates. The cost of gas is down, but most people don't realize the cost of gas is still up, and the overall health of the economy is not great. So, where does that leave us? If you're looking at just the current situation, and when I set out to make this video, my goal is not to make a super long video, even though I didn't make a video last week. So, at some point, I do want to go back and dig into strategy again, but let me see if I can just lay it plain. So when the Fed cuts rates, the Fed's been manipulating the economy for years, but for sure since they started causing inflation, or at least the last round of inflation. So they cause inflation and then they curtail it by raising rates. The labor market gets caught making up numbers. The economy is floundering, slowing significantly. And the Fed cuts rates finally when everybody can pay attention right before the election. So when the Fed cuts rates, everything in theory goes up, whether you like it or not. Now, in pretense, like, why would you argue against it? But everything goes up. Bonds go up. The stock market in general should go up. Lower rates should help everybody. But they also get into home prices. So regardless of how much you thought your home was valued before the rate cut, now suddenly it's valued more than the rate cut, which is going to eventually catch up on your property taxes. Uh, but if we isolate ourselves to just the market, when rates go down, bonds go up. But quite honestly, everything else should go up. is it makes everybody else feel better. You get more money pumped into the market. So you get this greed wave, more money in the market, more people buying and selling, really just more people buying, which pumps up the value of everything. So even if you bought stocks now, even if you bought bonds now, for the most part, you're going to be paying more than you were paying before the rate cut. And then there's that looming hope that the Fed will continue to cut rates in the next, I don't know, 4 to 6 months, maybe longer, maybe a full year from now. They're still cutting rates slowly. So money pours into the market. We hit a greed cycle. Things cost more than they used to, right? More money in the market. In the closed-end fund world, there's more being bought, so there's less available. So that makes the cost go up. It's just supply and demand. But if we look long term, if we look past the greed cycle, I still think recession looms. The labor market already got caught making up numbers. They got caught falsifying information. So I think the labor market's worse than what it appears. With recession looming, stocks would go down. So rates drop, everything goes up. Stocks, real estate, bonds, CLO, pick your category. It goes up. The economy slows. Uh, maybe not. They're actually honest about it. I think that's still 50-50 at this point. But the economy slows and people pick up on it. The cost of everything continues to go up. Recession fears loom. The price of stocks drop more. So in a rate cut, it makes it look like you have more money to spend. But in recession, you don't have as much as you think. So people pull back. So the only move that I can think of now that would be good now as well as good in a recession is bonds. Uh, I mean, there's a great counter real estate wise just based on discount and overall value. But I still, as big as the discount is, I still think the better play is bonds. But that's if you're buying. I would love to say, like, so this was the market in the sense of, so this is the market, rates go up, we want it to just, or rates go down, we just want everything to go up. It's going to be like this as we go up. So if you pull back the curve enough, yes, it'll look like an actual uh, straight line. But in the midst of it, it's not going to be a straight line. It's going to go up and down. It's going to be bumpy like everything else. But of what we know from rate cuts and looking forward into the overall health of the economy, when rates go down, everything goes up. But eventually we hit that recession and then the economy slows, or at least they admit the economy slows, and then bonds continue to go up and everything else drops. And as crazy it might sound to you, when everything drops and there's a bunch of fear in the market, that's a really great time to buy stocks. But if you buy right now, you're just paying more than everything else is worth. So if you're going to buy anything, you have to demand a discount. You got to demand a historic, like a better than historic discount. But for us, we're not buying right now. We're going to ride it out and see. Mostly because I want that price increase across stocks because we have some stocks that I want to sell. We have, and they're pulled up on my tabs. We have two mixed funds that deal with stocks and bonds that are roller coaster rides. And we bought them low with the intent to sell them high. We bought them with the intent to ride the roller coaster. And that's not a ride for everybody because you really don't know how quick or how long the ascent will take. But on a rate cut, both of those funds have increased. They're earmarked to sell at specific at price points, or at least at minimum price points. And we're really just monitoring the overall portfolio we have we're monitoring both portfolios. Don't get me wrong. We monitor the individual account as well as the Roth. But we have no plans to immediately sell anything in the Roth. Uh, but we have funds that we're earmarking for sale in the individual account. But I guess the best way to really talk about this is to give you a visual. I'm a visual person. So let's talk about the closed-end fund master, and then we'll go from there. So this is the master list, which is in need of an update, but I'll get to that next weekend. So everything that's in purple, blue, green, or this light blue get updated weekly, and everything else gets updated monthly. So if we screen this by targets, the target list has shrunk considerably. We take that top, paste it here, and let's see. This is the average price based on what we already own. Um, right, there we go. Current current number of shares, price of share, cost of share, shares, total investment. Seems a little redundant. So you get to see my mistakes. Cost of share, share, yeah. So we'll roll with it. This is the average cost based on what we own. These are the current shares we own. Uh, Updating this row or updating this column will update this column. So let's trim some extra. So as we look at this, all of these are significant based on their historical discounts. So we can rule that out as a criteria. All of them pay monthly. So we've been focusing on monthly targets. So next we look at overall yield, and the minimum has been 9%, unless there's a really good reason to pick something else. So if what's under this EXG, so you have all stocks, again, all stocks, still stocks. TEEF is a hard sell for me. TEEF is everything not oil, but it also means all of their products are dependent upon oil. It's equity in motion for non-renewable energy. And I say non-renewable because they all depend upon oil. So if you cut oil, all of their ability to generate energy through all these renewable forms doesn't exist. Take away oil and none of it works. That's a hard sell for me. CGO is still stocks. Um, let's see. Of the rest, that's really the only exception, just because of the discount. But if we're hyper focused on bonds, and generally I don't track it. Generally I don't deal with anything above 16. The only reason this would be on the list is because at some point somebody recommended it. So I track it. So if we get rid of everything under 9, but then we also go up, and these are both stocks. This is stocks. And we eliminate all of this, that leaves us with this. So we end up with bonds, a mix of bonds, like bonds and other stuff. This is mixed assets that we have in other portfolios. And this is utilities. But honestly, we get utilities in some other funds we already have anyway. So the utility boat has sailed. Utilities are currently at the upper, I won't say they're at the apex of things, but they're for sure, like, that boat sailed a year and a half to 2 years ago. So if you bought it now, you're paying more than it was. So if we hyper focus on bonds, then we end up with these four. But this is where the average price of things comes into play. And yes, this is our actual portfolio. It's not a single stock. It's not like a single share of what we've bought. This is our portfolio. So 7-Eleven 33. There we go. HGLV 7-1. FSCO 6-1. CIF 1.74. It's going to round. All of these have a higher buy-in cost than where we came from, than our average. So to get into the breakdown of each, then I can look at our overall buy price to see what would be a better deal in the mix. Okay. Uh, but we run into the same thing. So when you buy stocks over time, you're going to get the dollar cost average in the sense of, like, if this is the average, you're buying stocks below and above that average over time to have an average. So I get the idea of paying more for something than the average, but at the same time, me personally, I don't like it. Um, I mean, the goal is for you to buy stuff and it improve in value. But at the same time, I don't like paying more than the existing average. But that's the current state of things in a greed cycle. So if we were buying anything, and we're not, if we were buying anything, I would pick this, uh, or at least still these two, because of what's inside the portfolio. In a bond swing, so with lowering rates and bonds going up, I want to buy uh, high fixed income portfolios that are going to profit the most from a rate cut. And you could argue that this one would as well, but it doesn't have that high fixed income category, but it's also more than bonds. BRW is a shareholder activist portfolio, or shareholder activist management, where they want the shareholders to have better outcomes than what they currently have across the entire closed-end fund space. I like that. I can invest in that. But it's also bonds plus closed-end funds and Bitcoin and treasuries and this and that and the other. It's not just bonds anymore. So I can jump on BRW's bandwagon, and we have. But if we're going to prioritize still that high level of fixed income or that high level of corporate bonds, then it's these two companies. And you could make arguments for both of these companies. So if we bought anything on Monday, it would be one of these two, but we're not. Why is that? Well, one, quite honestly, is available funds. We'll get our September dividends paid tomorrow, of which point we would have enough to buy another 100 shares here. Current would be current shares. 3, 4, 5, and 2. Three. So, I mean, if we bought anything, yes, we could pick up another 100 shares here. But I also want to wait because I'm expecting the market to kind of to vacillate as that. I don't know. It's not a correction, but I still think it's going to swing with the existing cut and then with the hopeful pending cut. And I still think overall cost will continue to increase, but I want to use that to our advantage. In our individual account, if I scroll this way, there we go. We still have some funds. So everything in light blue is what we still own. So you end up with real estate, energy, oil, natural gas, energy movement, bonds, mixed fund, so stocks and bonds of what I have pulled up here. So you get stocks and bonds, stocks and some bonds, and long term, whenever they hit specific price points, we would want to sell them. And I mean, the goal would be to sell them in this account, transfer the money into the Roth, and continue funding our Roth as best as possible. So we're going to wait for the market to respond and wait for the rate cuts to really kick in and continue to ride this greed wave. But really, the Fed cuts rates again. My expectation would be that the ticker continues to creep toward extreme greed. And from my standpoint, that's when we really either A, we sit out, B, we wait, C, we demand the best possible discount we can. But it's also the don't be afraid to just sit on your hands and not buy anything because the market moves in waves, right? So as this continue, like the Fed cuts rates, this will continue to go up. And at some point, it's going to revert back, switch all the way back down, and either get into extreme fear or almost to extreme fear. And then that's the time to buy. You get an amazing discount on something that's decreased in value, still pays either the same dividend or a little bit less dividend based on the current economy. And then you're going to wait for it to swing back, right? And then not buy in extreme greed and then wait for it to tick all the way back down and then buy when it's in fear. And then that's kind of your buying gauge on the overall market. Right now it's you can buy, but it's cautious. Gotta have a killer discount. This would be, from my standpoint, unless it's a killer discount for whatever reason, just a unloved fund, like HFRO that's been 50% off for a while. You could argue for that, and then wait for it to come back, and then buy stocks here. But for our angle right now is to sit and wait. We'll see how the market shakes out. Try to get a better read on things. Uh, Still look for the recession coming up, and if we get the swing we want from the rate cuts, then these values will go up. This is oil. It's oil and natural gas. And then this is healthcare. But between HQL, GLO, and ZTR, those are on the immediate chopping block for us. But at the same time, we want to use that market momentum with that upswing in cost or that greed phase where everybody's buying more and then paying more for it right now. We want to use that wave to max out our return or max out our however you want to categorize or however you want to say that, and then sell these, and then same idea. It's taking the money out, transfer it over to the Roth, and even if it hangs out in the account waiting for the next wave, then we're still earning more than it would if it sat in a bank. So the long-term goal is to get rid of this account or say completely liquidate this account and then put all our money into the Roth. But at the same time, we're not just going to sell it willy-nilly because that kind of takes away the advantage of the market. The current market is rates down, bond prices up. Right now, it's rates down, everything up. And if we hit recession, which I still think we will, then it'll be rates down, everything down but bonds up. And then you get to debate the long-term overall strategy of selling your bonds and buying lower or holding out and riding the trough and collecting the dividends along the way. So Just because you're considering selling high doesn't mean that the strategy ends. You can sell high, or since the market moves and shifts, right? So as things are here and then bond prices go up in value again, you can sell high, wait for them to drop back down, buy them low, or you can wait for them to climb, collect fat dividends, and then know that at some point it's going to drop into a trough again and hopefully maintain that dividend. And then you would buy more low as it comes back into high. So it really just kind of depends on your overall strategy. For us in the Roth, we don't plan on buying anything. We want to use the current market momentum to uh, gain ground with some stocks still in the individual account so that as the price increase rises, we can sell at certain points. And then as we sell funds, really particular these three, as we sell, we transfer the money out and then we end up sticking it in the Roth and then we max out our Roth advantage or max out our Roth contribution every year. So that's really all I got. It's still more of what I said last week. The market is swinging in greed. With rate cuts, everything's going to be not topsy-turvy. It's just going to be like turbulence in a plane, but everything should go up. The bigger factor is how well or how poorly the Fed manages the economy and how successfully they end up hiding the recession. I mean, it really has. They cut rates finally, but our last two grocery bills are the highest bills they've been in the last, really in the last 3.5 years. So it as great as a rate cut sounds, it's not all bells and whistles. And as so I don't know, as sketchy a picture the labor department has created, it's still worse off than what they're telling everybody. So that makes me think recession coming. So using the current market and then looking forward, the best place to be right now is bonds if you're going to buy anything. But going forward, it's almost that we're going to, it's not almost, it's that we're going to use the existing momentum of a rate cut and let those stocks gain in value and let that greed wave go and let people pump money into the market so that value goes up and then sell those funds so that when the recession hits and everything drops off, then we have money sitting where we can buy for the recession and we can snatch a great discount and a super low price because right everybody's afraid so they sell things and then prices drop, they pull money out of the market, so you still get a crazy dividend or you still get a crazy discount, but you get a fat dividend and you get a really cheap buy because people don't want stocks, they want their money and they don't want the risk of having money in the market. So uh, let's see. So as you approach the week, whatever you have for the week, I hope it goes well. And wherever or however your portfolio is currently invested, my two biggest pieces of advice are, or maybe three biggest pieces of advice are be cautious, pay attention, and continue to educate yourself, and be wary of what the Fed and the Labor Department is telling you, because with a slowing economy, so the Fed's cut rates, the economy slows, recession comes next. And if all of that holds to be true, then you want to be well prepared for recession. You want money set aside in like you want money available so that when that market corrects and we have that drop and people start pulling money out of the market, you want to be prepared to buy because it will be buying season, right? The herd itself will run scared, and those talk show idiots will push the herd out of everything. So when the herd runs the other way, that's the time to buy, right? So Be wary, be cautious, learn, and then know your strategy. And don't be afraid to implement your strategy. I wish you a great week and good luck investing. Talk to y'all later. Bye bye.